Hi EUE traders, I'm Steve Edge. Well, we finally figured out a way to bring some European market structure news and make it entertaining for you on the big screen or small screen, depending on how you're viewing this, so sit back and enjoy. As this is our first show covering Europe, we should probably touch on the transaction tax issue. European governments are broke and they're seeking to squeeze more money onto their balance sheets while the European central banks keep printing money and subsequently interest payments. Well, I don't think you need to be a rocket scientist to predict that traders will move their business away from the tax. I mean, why would they pay an extra tax in one jurisdiction and they don't in another? Average consumers were driving their cars over the border to get cheaper gas or diesel or petrol, depending on where you're from. It's really very simple. The FTT will cause spreads to widen, liquidity will dry up, except in the new financial tax-free zone, of course. Consequently, businesses will close and jobs will be lost, and even more tax dollar revenue, income tax, will be gone. It's a mistake to tax trading, simple as that. They are also claiming that the transaction tax will call the so-called evil high-frequency trader.
I am your worst dream come true.
Ooh, the very people who tighten spreads and reduce volatility in markets. Yes, there are a few bad apples, but a blanket tax is really quite myopic. Get people back to work across the board in Europe. 30-hour work weeks, though, aren't the answer either. Lots of news out of the London Stock Exchange. A new chairman in Donald Brydon, the former chairman of the London Metal Exchange, seems a sensible choice, and Mary Shapiro will join as a non-executive director as well. She was the former head of the U.S. Securities Exchange Commission, as some of you already know. AIM, the exchange's junior board, turned 20, and an MOU, rarely worth the paper they're often printed on, with Haitong Securities, based in China, was signed. And speaking of China, the London Stock Exchange also announced it had received regulatory approval from Hong Kong Securities and Futures Commission to allow firms to become members of the London Stock Exchange. Why would a firm need approval from another jurisdiction to become a member in the first place? Well, there are around 220 members on the Stock Exchange of Hong Kong. You might be thinking, wow, that's a lot. Well, yes, it is, but how much business do they really do? Well, let's take a look at this. This is the Hong Kong Stock Exchange Participant Market Share Report by month. It's broken up into three categories, A, B, and C. If we look here at category A, it lists the top 14 members by market share, and you can see that the top brokers do around 52 to 57% of the Hong Kong market. Now, I'm sure all those brokers sit in Canary Wharf already. Category B is the top 15 to 65 by turnover, and they do about 1/3 of the volume. Well, now certainly some of them are in Canary Wharf too, or at least using Category A brokers to trade in the UK already. Now if we look to Category C participants, they're the remaining 140 or so brokers in Hong Kong, and they do around 10 to 12% of the market. But do you really even want them as members in the first place? I guess from a PR standpoint, the London Stock Exchange can say, well, we have X members more than any other exchange group in the world. Steve Grob over at Fidessa posted a column on his blog recently on requests for quotes under MiFID II, so I did a little research on it myself. I found, as the blog post indicated, that if I request for a quote, I have to tell everybody on the street, but only I can trade it. Well, if I'm the only one to trade it, why can't I report it after the fact or trade it within a certain window before it goes public? Here's an example. Two clients might RFQ for the same product, but I might quote them a different price because, well, they have a different credit rating, or one of them is an active user of my prime brokerage service. If both my clients can see my prices, one is going to be unhappy and know that they're paying more for the same product. Or let's suppose I have a portfolio of liquid assets that have been priced at an old price based on, say, interest rates. I could then request for quote, then make public current bid and offer prices that would have my portfolio valuation suddenly improve markedly, just in time for reporting to clients. Well, I'm all for transparency, but this really does need to have another look. In other news around the region, the Greeks were fining hedge funds last week in a last-ditch effort to pay its debt to the ECB. Oh wait, no, because they were short-selling incorrectly. I guess they forgot how to do it all of a sudden. The European Central Bank's Target 2 Securities Harmonization Project went live last week, but Monte Titoli, the Italian securities depository, withdrew from the project just before the system launched. Well, not to worry, they will join on the 31st of August instead, but I guess with the summer holidays on the way, it might be best to reconsider the go-live date. BME, Spain's exchange group, launched a transaction cost analysis service. It will measure implicit trading costs in most markets customers will trade in, but does the exchange really want to tell its customers how much slippage they're paying? Well, be sure to attend the Fixed Networking London Regional Meetup Thursday the 9th of July at 110 Bishopsgate. Well, that's our show this week as we see European market structure. We welcome any feedback, good or bad, on our show. Of course, advertising inquiries are always welcome and can be made at support@euetrading.com. If you're interested in Asia market structure, catch our Asia show too. For EU E-Trading, I'm Steve Edge.